The smart money's trap, why buying the dip is a dangerous game. You might think that when a stock price falls, retail investors are buying up cheap shares and getting one over on the big players. You imagine the smart money is losing out. The reality is the opposite. The more retail investors dive in to buy the dip, the happier the big players become. Or, you might assume the smart money sells all their shares at the very peak of a rally. The truth is, they can't unload much at the top. Why? Because before the main surge, they hold almost all the chips. Anyone who's traded stocks knows a peak doesn't last long. The moment the big players start selling in earnest, the price plummets. And when retail investors see the price drop, their first instinct is exactly what you'd expect. If it falls far enough, it's a bargain. So they jump in. The price might even bounce a little, convincing them they're right to wait for the next big wave. But after a brief rally, the stock hits new lows. What's your reaction now? You average down. You think, the lower it goes, the more I should buy. It can't possibly fall much further, right? When it's down 50%, you think a rebound is due. But any minor recovery is still far from your break-even point, so you buy even more to lower your average cost. Then it drops again. And the bounces become weaker and weaker. Why? Because the smart money has been selling into every single rally. They've been using the retail investors by the dip mentality to exit their positions. Once they've sold off their holdings, who's left to push the price up? The masses have already trapped retail investors? You might protest, the stock got cut in half. How could the smart money still profit? Look back at the chart. Why did you notice this stock in the first place? It probably rose 70 to 80%, or even double. You saw its strength and were lured in. If a stock goes from $20 to $50, the big players are still hugely profitable even if they sell between $30 and $40. They've also been trading the swings on the way up, lowering their cost basis. They even sold a small portion at the very top. Take this case, the stock ran from $2 to $12. It's unrealistic to sell everything at $12. So, they use the retail dip buying psychology to sell gradually on the way down. Even when the prices have to around $6, they are still selling profitably. Every rally during a downtrend is manufactured for one purpose, to lure in retail buyers who think the bottom is in, creating exit liquidity for the smart money. They've run the numbers. They understand the retail mind perfectly. It's like a merchant who has a product costing $3, inflates the price to $12, then offers a limited time 50% discount back to $6, creating a false sense of urgency and demand. You see it and get tempted. The moment you buy, the merchant's goal is achieved. Hoping it will go back to $12 so you can profit is a fantasy. Once a stock is loaded with trapped retail investors, any new big player wanting to trade it will employ the same tactic, buy a little, then smash the price down ruthlessly. If a $12 stock falls to $6, they collect some shares, then drive it down to $3. Why? Because by then, most retail investors are already all in and out of cash. They can only watch helplessly or capitulate. There's no buying power left to oppose the selling pressure. That's why declines often accelerate on low volume at the bottom. It takes very little selling to cause a big drop when there are no buyers. When the price hits $3, the visible resistance is up around $6. The smart money then chops the price around $3, testing the patience of retail holders. They force those who can't stand the pain to sell at the bottom, or get them to chase tiny rallies and then get stopped out again. By trading the range between $3 and $4, their average cost might end up around $3.50. Once they've accumulated enough cheap shares, they run the price up to just above $6, making it look like a major breakout is starting. When a crowd rushes in to buy, the smart money sells to them without hesitation. They don't need a long time to exit because they didn't accumulate a massive position at the very bottom. As long as there are momentum chasers, the exit is swift. This is why strong rallies from the bottom on high volume often end abruptly. The large green candle and surging volume are the distribution itself. After that player leaves, the next one might come in and repeat the cycle. This continues until the stock is truly washed out, with no more weak hands to squeeze. Only then can a real, sustained bull market begin. What you thought was the bottom was merely a ledge on the way down. Even if a bull market arrives years later, you've likely either sold at a loss at the bottom or bailed out the moment you broke even. Any massive gains that follow have nothing to do with you.